In this video, I'm going to talk about the 10 best stocks for retirement. Where did I get these from? Each month, this channel and Simply Safe Dividends team up to bring you an article about the 10 best stocks for retirement. The articles are written by Brian Bollinger, who is the founder of Simply Safe Dividends. The idea of the 10 best list is to highlight appealing stocks for retired folks. Brian picks stocks that offer average yields above 4%, solid dividend safety, low volatility, and at least 5 or more years of annual dividend increases. What I'm going to do today is to add 2 more pieces of information that I think are very important. Quality snapshots for each stock and their valuations. I'm Dave Van App for the Dividends and Income channel. Before I get going, please help us out by clicking the thumb up button if you appreciate this content, subscribing to the channel, and ring the bell to get notifications of future videos when we post them. That helps us out a lot, and I thank you for doing that. Before I get going with the stocks themselves, I'm going to take just a couple of minutes explaining the quality snapshots and valuations. You may think that you're not interested in this background, but I do hope you'll sit through it and watch it. It's only a couple of minutes long, and I think that you'll benefit from it if you stay with it. I base my quality snapshots on 5 factors that I get from trusted, independent sources. They're listed on the left side here. Two of the snapshot factors come from Value Line, one comes from Standard & Poor's, one comes from Morningstar, and one comes from Simply Safe Dividends. The rating factors are shown in the middle column, and in the right column you see the points. There are 5 factors, and I allow each one to get 0 to 5 points. In their original sources, they all have different scoring systems, but I found a way to assign from 0 to 5 points to each factor. So the maximum total score that a company can get on its quality snapshot is 25 points. Down at the bottom, I've indicated how I parse those scores out. 23 to 25 is considered excellent. 19 to 22 is above average. 15 to 18 is the low end of what I consider to be investable range. And anything below 15 points I consider to be a speculative investment, and I personally don't invest in those stocks. And as always, as indicated at the bottom of this display, I use colors to indicate where we are in terms of good to bad or bad to good. So dark green or light green are good. Yellow always means average or acceptable. And either orange or red always indicates something that's below average or, in the case of red, unacceptable. I have found that the simple 5-factor system is very effective at separating high-quality investable stocks from low-quality and what I would consider to be uninvestable stocks. Let's talk about valuations. Valuation is a process of determining how much a company's stock is worth. It's an assessment or an appraisal, not an exact measurement. It can't be measured exactly because the right answer won't be known until the future. The real worth of a stock is called its intrinsic value. And at this point, I'd like to introduce you to Warren Buffett to explain how to value a business. This clip lasts for about a minute.
If we could see, in looking at any business, what its future cash inflows or outflows from the business to the owners or from the owners would be over the next, we'll call it 100 years, or until the business is extinct, and then could discount that back at the appropriate interest rate, which I'll get to in a second, that would give us a number for intrinsic value. In other words, it would be like looking at a bond that had a whole bunch of coupons on it that was due in 100 years, and if you could see what those coupons are, you can figure the value of that bond compared to government bonds if you want to stick an appropriate risk rate in. Or you can compare one government bond with 5% coupons to another government bond with 7% coupons. Each one of those bonds has a different value because they have different coupons printed on them. Businesses have coupons that are going to develop in the future too. The only problem is they aren't printed on the instrument, and it's up to the investor to try to estimate what those coupons are going to be over time.
This display shows what I think to be the major points about valuation. First, its definition means to determine the intrinsic value of a stock, a share of stock. How much is it worth? In the second column on this display is one of the most famous quotes from Warren Buffett, not shown in the video, but he has said elsewhere, "Price is what you pay, value is what you get." And what that means is that in the market, stock prices go up and down while the value of what you're getting may not be changing hardly much at all. Certainly not second to second the way prices change. So price is what you pay, price is what you need to pay to buy a share or 10 shares or 100 shares of stock, but the value of what you get may be different from the price. And that's why we do valuation, to figure out what is a good price to pay for a stock. Third column, As I said before, valuations are estimates or appraisals. They're like house appraisals. Reasonable minds will differ on what is a correct valuation for a share of stock, and none of us will really know the answer for 3-5 years from now when the factors that play on the value, the true worth of a stock, get a chance to play out. And in the last column, I underscore the fact that valuation cannot be measured. It's not a physical property like the width of my personal computer that I have in front of me. Valuations are estimated using available facts and logic and making projections. And because they're projections, they're about the future, and nobody knows exactly what the future is. Okay, this display shows how I value stocks generally. Again, I use trusted sources. I have factors that I use and a process that I follow. My trusted sources are Morningstar, a company called Fast Graphs, Simply Safe Dividends again. The factors. Morningstar uses discounted cash flow analysis, which is exactly what Warren Buffett was talking about in the video clip. I think they do a pretty good job with making estimates and trying to project unknowns into the future, and so they are one of the trusted sources I use. Fast Graphs, which many of you have undoubtedly seen, uses a different approach based on PE or price to earnings ratios, and I use two versions as different models for my own valuations. Simply Safe Dividends provides a source for comparing a stock's yield. I'm always talking about dividend stocks, so they always have a yield. The current yield to the 5-year average yield. The idea behind that, which is called the yield metric or relative yield, is that if the stock's yield is somewhat above its 5-year average yield, it may be underpriced. It may be selling for a bargain. And if it's below its 5-year average yield, it may be overpriced and not a good time to buy it. For my process, I examine each of those sources. I make adjustments where I think something may be an outlier or not making much sense compared to the others, and then I simply add them up and average them out. And what I get is shown at the bottom of the screen. I get what I call a valuation ratio. What is the ratio of the stock's current price to what I've calculated to be its fair price? 1.0 would be stock's price matches its valuation fair valuation that I've calculated. And I give myself a little wiggle room around that. For the purposes of this video, I've used 5% up or down. So a valuation ratio of 0.95 to 1.05, I consider that band to be a fair valuation band, and it's colored yellow, again using yellow for average or middle. To the left, I consider anything under 0.95 to be undervalued, meaning the price is 5% or more below my calculated fair price. And at the right side, overvalued, colored orange, is 1.05 or above, meaning that the actual price is 5% or more higher than what I calculated the fair price to be. Let me move on to the 10 best stocks as enumerated in Brian's article. Here they are in alphabetical order. You'll see some well-known names like Duke Energy, Philip Morris, and Verizon. Some of the names may not be familiar to you. There are 6 economic sectors represented, so it's a fairly diverse group considering that there's only 10 stocks listed. As I said, these are in alphabetical order. Now I'm going to switch the display to include all the quality snapshot and valuation grades. The list will still be in alphabetical order. So here on this slide, we see that everything has been graded, and it's actually quite a hodgepodge. This display is not very useful because things are all over the place now. Alphabetical order doesn't work anymore when we're trying to zoom in on good and best opportunities and so on. You will note that some of the stocks, some of the squares, the cells in this table labeled NA, not available, and aren't colored in. That's because in the sources that I use, the stocks weren't covered or didn't have an analyst covering the particular stock, and I couldn't derive a grade for that particular factor. And so in the second last column where it says total points, 1, 2, 3 of the companies end up with an NA there. I couldn't derive a total score for those, and I'll talk about that a little bit as we go along. But what happens if we sort it by the last 2 columns, the total quality snapshot points and the valuation ratio? Now the cream rises to the top with that sorting. The most undervalued stocks are at the top. The most overvalued stocks are at the bottom. 2 of the 3 unrateable stocks are overvalued near the bottom. I can suggest this. You might want to pause the video to look at that table more closely or take a screenshot screenshot of it so you can save it off to the side for later use. I want to finish this video by briefly talking about the top 3 stocks in that table. Here they are, the top 3. Let's focus first on the top 2. Enterprise Products Partners, ticker symbol EPD, and Magellan Midstream Partners, ticker symbol MMP. You can see that these two companies have practically identical quality snapshot ratings across the board. You see the same color in every category, and they both total 17 points. Both of these companies are Master Limited Partnerships, or MLPs. What is an MLP, you ask? Okay, this display shows MLPs in a nutshell. In the left column, the definition. MLP, Master Limited Partnership, is a partnership, not a corporation. If you invest in one, you don't become a shareholder, you become a limited partner in that enterprise. Second column, how they make money. Master Limited Partnerships can exist in practically any industry, I suppose, but where they predominate is in the oil and gas pipeline industry. They're called midstream assets. In other words, they lie between the discovery and production of oil and gas and ahead of the end users or customers or people that make more complex combinations of those products. As midstream assets, they collect fees for moving, storing, and doing a little processing of oil and gas products and chemicals. Third column, as I said, they are distinct. Master Limited Partnerships are distinct from corporations. What you buy are called units, not shares, and what they make to you are called distributions, not dividends. Those are technical points that you really don't need to pay a whole lot of attention to most of the time. Most investors refer to the distributions alternatively as dividends, and nobody gets fooled. They still have yields. They still have dividend growth rates. Nobody that I know of reverts to saying distribution growth rates, although that would technically be correct. The fourth column is important because there are tax ramifications to this. Point number 1, most distributions from partnerships are considered return of capital. They're not qualified dividends under the tax code. Number 2, that means that they reduce your cost basis. You do not pay taxes on them when they are delivered to you or in the year that they are delivered to you. Rather, they lower your cost basis. So if you paid, say, $25 for one unit in an MLP and they pay you $1 during the year, now your cost basis for tax purposes has been lowered from $25 to $24, but you are untaxed on that lowering. It's an accounting entry. The only time that will come into play is if and when you sell the shares of the partnership, at which time you will owe more tax because your gain, assuming you had a gain, will be larger because the cost basis will have been lowered. Also, if you hold it long enough that when added together, many years of distributions wipe out the entire price that you paid for the shares, they will be taxed in the year that you receive them. And finally, to carry all this out, the IRS, or the companies rather, issue a K-1 form rather than a 1099 form. And a lot of shareholders just hate K-1 forms because they're complex and they often come out late. But I'm told that most tax handling software handles them just fine. Just follow the instructions. And if you have a CPA or a tax specialist do your taxes, they'll take care of that, the complexities for you. Now, here are the two companies again, this time comparing their distributions. You can see that EPD, they're both in the energy sector, obviously. EPD has of 8.6% and a 5-year dividend growth rate of 3% a year, and MMP has a yield of 9.3%, 5-year dividend growth rate of 6% a year. On this display, Enterprise Products Partners is the purple line and Magellan is the orange line, and you can see how the faster dividend growth rate or distribution growth rate of Magellan has played out over the last 5 years. However, I would point out to you that most of the advantage of Magellan's happened in 5 years ago, 4 years ago, and 3 years ago. The last 2 years have been rather equal, so I wouldn't put as much store necessarily into the much faster 5-year dividend growth rate that Magellan has displayed over Enterprise. We've already seen on their quality snapshot grades how similar these companies graded out. There are some more things I just want to mention about them. They both have dividend growth streaks of at least 20 years or more. And the pipeline business itself has attractive qualities, including the fact that to build a pipeline requires a tremendous capital investment and a long time to complete a pipeline. And those facts discourage competitors. Only so many pipelines are needed in a given geographic area. The demand for moving oil products tends to be stable. It's somewhat price dependent on the underlying cost of oil, but not totally. And many pipeline companies, and both of these, for many of their customers, they have long-term contracts. So the carriage fees, to some extent, are guaranteed. Both of them have wide moats from Morningstar, indicating that they're expected to be able to fend off competitors 10, 15, 20 years. That's what a wide moat from Morningstar means. Okay, finally, about these two MLPs, let's talk about their valuation. As you may have noticed on the earlier slide, I end up saying both of them, calculating that both of them are 20% undervalued right now. On the left, you see my valuation estimates for EPD. I have a fair price range of $31 to $35 a share, computes to a fair yield of 5.1 to 5.8%. And at the bottom, colored in green, you can see that the 20% undervaluation is in play right now with an approximate price or a recent closing price of $26. That's well under the fair price range. Current yield of 8.6%, which is well above the fair yield range. And on the right, the similar slide for Magellan, fair price range of $52 to $61, fair yield of 6.8 to 8%. But the actual recent selling price for Magellan is $44, which is well under the fair price range, and its yield is 9.3%, which is well over the fair yield range. So I think both of these stocks or partnerships are great buys right now, and if you're interested in buying or adding either or both of them to your portfolios, now would be a pretty good time to do it. Now let's move on to the third company in the top three from this group, Verizon Communications. You can see that Verizon is in the telecommunications sector of the economy. Its yield is 4.8%, not as much as the two master limited partnerships, but what I consider to be a high yield, and its growth has been steady at 2% a year. On this display, we see how Verizon lines up in terms of its scores on the quality snapshot and valuation. Verizon, it turns out, is the highest quality company of all the companies in the 10 that are in the 10 best retirement stocks list, with a total quality score of 22. And you can see that it gets green colored ratings in all of the factors except for its credit rating, which is an investment grade BBB. And I compute its valuation as being a 0.86 ratio price to fair value, which would suggest that it's 14% undervalued. Let me say that Verizon is a popular holding for many retired investors. I hold it, and I hold it for the same reason that many others do. I value safe income and capital preservation. Verizon is the largest wireless service provider in the country, and its 4G LTE network is available to over 98% of our country's population. Its wireless operations account for about 70% of its total revenue and nearly all of its profits. Verizon invests big time into its wireless network, which produces reliability, speed, and good network performance. Customers over the years have noticed it. Verizon has emphasized it in many commercials over the years. And when I say customers have noticed it, Verizon has only about a 1% per year churn rate in its customers, which is an outstanding record. Not many customers abandon Verizon once they're part of the network. My wife and I are on Verizon. We have been on Verizon since we first owned cell phones a couple decades ago. Here is Verizon's beautiful dividend growth chart. It's got the stair-step pattern that I love to see in any investment that I make, meaning that Verizon has raised its dividend regularly every year, pays 3 dividends at one rate, raises it, pays 4 at that rate, raises it, pays 4 at that rate, and on it goes. Verizon has paid dividends since it was formed more than 30 years ago, and it has raised its payout for 15 consecutive years, with its most recent raise just announced in November. Moving on to Verizon's valuation, I have a fair price range on it of $59 to $65. As I said before, I think it's about 14% undervalued at this time. That translates to a fair yield range of 3.9 to 4.3%, and as we see in the green box, its current or a recent selling price for Verizon is $53, which is well below the fair price range, and that translates to a yield of 4.9%, which is well above its fair yield range. So again, if you're interested in Verizon, now would be a good time to grab some shares. And thank you guys for watching. That wraps up this video. Don't forget to subscribe. Have a happy new year, and goodbye, everybody.